Insurers typically prepare two sets of financial statements, one based on SAP and the other based on GAAP. SAP is primarily focused on solvency and the ability of the insurer to meet its obligations to policyholders. GAAP treats a business as a going concern and focuses on measuring earnings from period to period. Differences in these two accounting methods may lead to significant differences in the reported financial position of an insurance company. Let's take a look at how one difference, the recognition of policy acquisition costs, shows up on an insurer's balance sheet. I've reproduced the table included in your textbook so we can walk through this together. This sample insurer incorporated on June 30th with $1 million in cash, with no liabilities, and a total policyholders surplus of $1 million. The next day, the insurer wrote a policy for $210,000, paid in full. Underwriting expenses, including the agent's commission and premium taxes, are 15% of premium, or $31,500, and are immediately paid out. Expected losses are 82% of premium, or $172,200, assuming that the loss experience turns out as expected. The insurer realizes a profit on this policy of $6,300. So you take the premium written, 210, subtract the acquisition expenses, subtract the losses, and at the end of the first policy period, we have an underwriting gain of $6,300. Assets, therefore, go up by $178,500. So here we have assets. We have the original cash. We have the additional $178,500, which is the premium minus the acquisition expenses, gives us more cash, $178,500 more. However, we lose our expenses and the policyholder surplus drops because we recognize the acquisition expenses immediately, even though we recognize the revenue over time. You can see that here where we put the $210,000 into the unearned premium reserve, and then while we would actually earn this day by day, on this chart it shows after 6 months we've earned half of it, and then by the end of the policy period we've earned all of it. But we continue to subtract the acquisition expenses as though the revenue were all recognized up front. So as a result, we have lower surplus. 1 million minus the expenses equals a lower surplus. It does, at the end of the full policy period, equal out to the $6,300 profit in addition to the initial million in terms of the policyholder surplus. Under GAAP, however, let's look at how that same sale and same expenses would be treated. Under GAAP, you create an asset called deferred policy acquisition cost for that 15% of $31,500. So the same acquisition expenses, except now it's put into an asset account instead of immediately expensed. And over time, we begin to subtract those expenses at the same rate that we take ownership, if you will, recognize is the correct accounting term, the revenue. So as a result, we don't see that drop in surplus that we saw up here under SAP. At the end of the 12 months, both GAAP and SAP are equal. But imagine if you were looking at the value of this company at this point in time. Under SAP, it would be $987,400. Under GAAP, it would be $1,003,150. So hopefully this example helps you see how SAP values the surplus, which is the company's cushion against unexpected financial impacts, more conservatively than GAAP. So just let yourself imagine how this valuation difference would be for a typical insurance company with many sold policies rather than just one. And SAP's focus on solvency versus GAP's ongoing concern perspective becomes glaringly obvious.